Here's the latest and greatest in the financial sectors that affects here, Metro Detroit, and nationwide. But before going forward, I want to send a thank you to a couple of people who have reached out, noticing that I definitely try my best to stay out of politics, stick only to facts. One review found this channel refreshing as a source of pure data without anything being skewed, and more, how the data works and plays together with each other. On this video, we're covering, of course, the jobs report, inflation, housing, rents, but also gas prices and what's happening there and more. If you're new here, first, thank you for stopping by and definitely watch to the end. We've got a few predictions on what's coming next and how to turn that to you and your family's advantage and have a great giveaway in this video. Let's jump in. Gas prices got 99 days of price drops in a row over the summer into September, but they only got 99, could not get that last one to make it to 100. A group of countries, including Russia and the OPEC nations, the Organization of Petroleum Exporting Countries, who control 50% of the world's oil supply, have decided to ship 2 million less barrels of oil per day to countries that need it, like Europe and frankly ourselves. And why? It's all about the dollars. And literally, because oil is tied to the dollar, like everything is predicated on the dollar, and they feel like they're not getting enough of them. The bottom line, expect higher gas prices over the next 2 to 4 weeks. President Biden has decided to release 15 million barrels of supply right to the market, and it's going to have a very negligible effect. First Friday of the month, as always, the job report did drop. It's a good case of good news and bad news is good news and good news is bad news. 250,000 jobs created was the expectation, but what we got is 263, with unemployment falling from 3.7% to 3.5%. The last time it was at 3.5 was May of 1969. The downside is the slowest jobs creation month since December 2020. The bad news, jobs are usually a good thing to have and have created, and we're creating less of them, which is actually the good news in this case. So rising interest rates are starting to have an effect on hiring, causing employers to curb their rampant hiring and needs and expansion of departments and growth and etc. But why is that good? Businesses put a large strain on supply chains, and the law of supply and demand comes in here. If businesses are soaking up things and regular folks like you and I are trying to buy those same things, prices go up, hence inflation. A slower jobs report means something as simple as less desks needed, less machinery, less stuff, which will ease the inflation rampage. In a perfect scenario, right now, the jobs report in the next couple of months will flatline around 100K, which is a lot less than what we have, and bring down that overheated market to a normal market. The bottom line, we're going to expect the job markets to cool through the winter to a 150 or a 100K, but the unemployment rate to remain at or below 4%, and wage growth slowing from 5% to 4.5%. And inflation, it is still high, and there is no need for a video to say that. You see that every day in what you buy. I was actually in the grocery store looking at eggs yesterday and literally staring at the prices. The guy walks up and says, they ain't getting any cheaper, just buy them. And he's right, because tomorrow they'll actually probably be more expensive. Specifically, the inflation rate is remaining high in these areas, especially around food and energy, and at 8.2% for this past month, the easing has not started yet. Interest rates. So they're going to go up further. Hot off a 0.75 rate hike in September, we're going to see another 0.75% rate hike on rates over the next 30 days because of the last topic, the inflation rate. If you're looking to buy that house or that car, lock in your rate now before it goes up further, and it will go up further. The Fed with the next rate hike is very likely to course correct the economy and send the economy and stock market plunging even further down. Also, if you're looking for a new way to get a lower rate, one of our lender partners has a project called a 2-1 loan or a 3-2-1 loan. So what this means is if rates are at 6.5% now, the first year will be either at 4.5% or 3.5%, the second year at 4.5% or 5.5%, then the third year back up to the normal rate. This is not one of those garbage loans that helped the economy crash that were given out between 2000 and 2006, of course leading to the 2008 meltdown. Your approved loan limit will not go up like they did before, and it is based on a great credit score, of course, is based on assets and income, none of those Nina or Ninja loans. The bottom line is interest rates are going to drop fast in late 2023 or early 2024 when the Fed realizes it had course corrected one direction, and it will course correct again the other direction, lowering interest rates to try to spur the economy, correcting that mistake. When it does, home prices are going to shoot up with buyers jumping back into the market, but the homes for sale won't be there because of the golden handcuffs. More on that in a minute. Get that house now with a loan like a 2-1 or a 3-1 loan and get that low temporary interest rate, then refi in 2024. The stock market. September has historically been a down market for the stock market the majority of the last 50 years, so this was an expected thing for it to fall. Typically, it falls an average of 1% every September, but this past September, it dropped a little bit over 9%, wiping out trillions of dollars in equity. So the last September that was worse than this was September 2002 at 11%. Like that October in 2002, we're going to see stocks further decline, first because of the strong jobs report that has already happened, the strong inflation numbers, which is still way too high, and also some weak earnings reports that we're seeing starting to surface. I'm not an investment advisor or an accountant. Please consult professionals on that. When asked what I do during a bear market, and it is more certainly that, I say 4 things. First, America is still the strongest economy in the world. The international markets are more risky, and in good times, of course, that means a little bit more return, but in weak times like this, it means a much bigger risk. Bet on America, invest in mutuals and ETFs packed with American companies. Second, this is the time of the not sexy stocks. Coke, Pepsi, Darden Restaurants, which owns Olive Garden and others. They're going to take a beating like all stocks do, but people seem to always buy soft drinks and eat at Red Lobster and Olive Garden. These stocks also spit out a decent amount of dividends and are considered dividend aristocrats. Dividend aristocrats, and there are 65 of them that are listed, have performed well and have raised their dividends every single year for the last 25 years plus, and that's actually the definition of it. Look hard at those tried and true stocks. 3, keep investing. Up or down, high or low, the proven method has always been to steady Eddie invest. And 4, call your accountant now, not next year, right now, and ask about tax loss harvesting. I'll talk more about this at the end, but when the market is down, you may as well get some sort of a tax advantage on it as soon as you can. The first 5 people that comment, I called my accountant, subscribe to the channel, and like this video, I'm going to send them a copy of The Psychology of Money. If you already have it, then you can have any other book on my shelf. Real estate. Oh, real estate. As a 21-year real estate professional, it's probably not a shock when I say it is always a good time to buy a home. But for real, I'm actually putting my money where my mouth is. I bought 3 so far this year as investments, and I'm looking for 2 more because I do believe this is the vehicle to own for future income and wealth creation. I have a lot to say on real estate, so stay with me. If you're looking for a home and you want a skilled practitioner to guide you through to find a great investment that has more than 2,000 plus 5-star reviews, give us a call. 248-221-2777. We'd be honored to help your family get into your next property. Real estate first thing, monthly payments are up significantly. Now check this chart out. Year over year on a $200,000 loan, payments are up $381 per month. On a $400,000 loan, $762 per month, and on a $600,000 loan, $1,142 per month. Those numbers are not small, and it ain't nothing. Now the number of homes on the market in Metro Detroit is up 14%, but the number of sales are also down 17%. Now that sounds bad, but really, it's about the market getting back to normal. Even with sales down and homes going up for sales up, 1 out of 6 homes in Metro Detroit are still receiving multiple offers here in October, but that also means that 6 are not. That's called a parity, an even keel market. Normal. What this means to you: if you were boxed out of the market because you didn't have the money to overbuy an appraisal or waive an appraisal or give free occupancy or do any of those crazy terms, now is your time. Seller concession guys are back. Negotiating below list price is back. Have a home to sell? I'm always blown away and grateful by the dozens of people that call us every single month to help them sell their home. And to be clear, I want to earn your business for life, not just have it given to me. More and more, I'm advising sellers one of 2 things. Either stay put because of your fantastic interest rate that you're not going to get right now, hence the golden handcuffs, or use it to your advantage and rent out your current home for a few years instead of selling it. Values are going to climb back again in 2024, and 2 years of making extra payments on a loan, plus the profit that you're going to get monthly from rent, goes a long way to offsetting some of this inflation. We're viewing selling the home as the last option, not the first option right now. Give me a call, we can help. So let's recap before we end the video. If you're renting, buy a home. If you're selling, rent it instead of possible or stay put. Gas, nothing to do here, but unfortunately, do what the rest of us are doing, suck it up. Higher gas costs will impact inflation this winter and impact it in the wrong way. So we're gonna see interest rates rise because of it. Jobs report, because interest rate increases are coming, ask for that raise now, because raises will not be given out at the same rate. Employers are not going to be increasing wages at the same rate early next year as they will right now. Get that yearly review out of the way. Pull it up a full quarter in time. Ask for that new position at the job. Ask what else you could be doing to impact how much you make, because these opportunities will probably not be there for employers next year. If you're considering a job switch to that job that might pay more, today's the day. Now's the time while we have a strong jobs report. Tax loss harvesting. This is where you sell a stock or a mutual or an ETF for a loss and then claim the loss on your taxes. An individual can do up to $3,000 per year. Call your accountant because there are some rules around it. The major one being you can't rebuy that same stock or a similar investment for at least 30 days, but you can buy something else immediately. Inflation. At 8.2%, it is still scorching hot, and the Fed is going to batter that thing down. Having a discussion with my father last night over dinner, he is adamant that the Fed is not going to raise interest rates anymore. I disagree. I think just like anything else the government does, they're going to overswing one way, and now they're overswinging the next. Do not be surprised in December or January when we see home mortgage interest rates hit an 8%, not a 7, an 8. It's what's coming. Last but not least, a little good news on the horizon, tax bracket adjustments. So because of this inflation, every year, most of the time people don't notice this, but every year since 1985, the tax brackets themselves have adjusted up with inflation, usually 1.5% to 3%, barely negligible. This year, they've adjusted up a full 7%, trying to match with inflation, which means that the lower tax brackets just went up 7%. Doesn't save you a lot of money, but I will take any money right now. My name is Mike Perna. Thank you again for tuning in. If it's your first time on the channel, subscribe, hit the like button if you found any part of this video helpful so that more people see it, and we would be honored to help you find a home or sell your current home in Metro Detroit. Give us a call anytime at 248-221-2777 and email us anytime at mikeperna@thepernateam.com.